Kathy Jones, George Bory, Jim Bianco still with us too. George, your view on this. What a way to end the year.
Yeah.
Triple C's, massive rally, 12 straight days of gains. Why?
Yeah, well, I think across high yield, you're basically pulling in, 2020 returns into 2019. And I think there's kind of a year-end squeeze that's going on as people scramble. We just talked about yields in general, look for that recovery trade. Where can I get the incremental yield? Where can I get the incremental return? How can I set myself up for next year? And we've seen a very meaningful squeeze into the market. Triple C's, if you look across that universe, there's about 10 companies that are up anywhere from 10 to 20% in returns in just the last month.
Is that concentrated?
Just the last month. And that's the interesting thing about Triple C's. It's a very, what we would call idiosyncratic. It's very company specific. It's not an asset class in and of itself. It's a basket of very specific companies that are doing very different things. Now, it is definitely the high beta part of the credit market, so people will use that as a beta trade. But right now, Triple C's are basically a bet on two things, and that's basically energy and then, to a certain extent, retail. And, there are a few other plays in there. But those are your two bets. And so people, I think, have been creeping back into the energy trade as oil prices have come up. And they're looking for that to be the next sort of big play for next year.
Kathy Jones, your thoughts on this? You've been cautious, conservative on this programme. Spreads have gone tighter. You've been cautious, conservative on this programme. And we're starting to pick up the laggards in Triple C's. Right. As you sit here and look at this at the moment, what are you thinking?
I'm thinking this is this last push where people are willing to buy just about anything in order to get a little bit of incremental return, and they're disregarding the risks involved. So it's not too surprising. It's end of the year, not that much liquidity. We've had a little bit of a rally in oil prices, which has given us a boost. They're not afraid of duration. So it's not too surprising, but would you really want to hold it for any length of time here? We think not.
What do you think, Jim Bianco?
I got to agree with George and Kathy. I mean, the Triple C's in the early part of an economic cycle, it's a bunch of beaten down cyclicals, and that's why you want to run into it when you're coming out of a recession as they rally. When you get a late cycle like we are now, it's the land of misfit toys, to stay with the season. It's a bunch of broken companies that have problems if you're in Triple C's in the 11th year of a recovery. A lot of it is energy. It's been rallying, energy's rallying, but let's step back from the last 12 days. Triple C's have been a terrible investment for the high yield market all year. They've lagged everything else. They're highlighted by energy, which has lagged everything else as well, too. I think the only reason somebody would want to buy that stuff is if they're a turnaround or workout player that thinks they could come in, fire management, sell off assets, and restructure the company. If you're not in that game, at this stage, I don't think you want to be playing in that space.
Jim, I want to pick up on something you said. We're in the 11th year. Why is that relevant? I'm just thinking about this because spreads are back to levels where we were 2014, 2018, and you could have taken that as a signal then that we were late cycle, and yet still, here we are, staring down the barrel of 2020 and looking for more expansion. So why is it relevant that we're in year 11 and spreads are where they are?
Well, I think from the Triple C perspective, to stick with that, is that any kind of a cyclical that's been sold off, that was sold off early in the recovery, has recovered. So anything that's left in that category right now when you get late cycle is a problem credit. And that's pretty much all the way up and down the line, is that there's really hard to find value at the lower ends of the credit. It's hard to find value in the triple B sector in investment grade at the end of a cycle as well, too, because it isn't just the general sell-off that you would get coming out of a recession. And that's why I think people have to look at these. I think George had it right. It's just a collection of companies. It's not necessarily thematic. It is thematic at the beginning of the cycle.
The risk, I guess, George, is that this continues, and then you start to look at the other places that didn't participate this year, leverage loans and elsewhere. What are your thoughts on that?
Well, I mean, I think if you kind of look across kind of credit in general, the leading edge of the sell-off was certainly in the loan market. And I think you could make the argument that there is some incremental value there, especially when you think about some structured products that package up loans, like a CLO. There is some value there. But it's sort of buyer beware. You have to be careful about what you're buying. You have to look very carefully at the managers, at the loans themselves. And so we would take a somewhat cautious approach. but those prices were down pretty dramatically just a month or two ago, and so there was some genuine value there. Our central message for kind of high yield overall, though, is take a more defensive stance. So be realistic about what the asset class can actually deliver. Anything greater than a 3% return, once you start to sort of carve out sort of the more risky or less liquid parts of the market, would be impressive in our opinion, given where yields are starting, given where spreads are starting. But at 2 to 3-ish, call it I would say like a 3 to 3.5% total return on a relatively low risk profile portfolio is very achievable.
Kathy, I know your take is that we've seen the price appreciation. I imagine many people share that view that next year for high yield, a story of coupon income. For you, though, George, investment grade, I was looking through your base case, just a bit of spread widening in there through 2020. What's driving that?
So I think it's a couple things. Number one, we've had a tremendous, technical backdrop, huge inflows into the asset class. Now that's across fixed income overall, so we think that moderates. But the other thing that was a big kind of sea change this year is a lot of investment grade companies actually started to reduce debt. And you don't typically see a company deleverage voluntarily. But we had a few very big names, very large cap companies that purposefully tried to delever or modestly restructure their balance sheet. The pace of that is likely to slow next year. And the pressure on companies to continue to do it is likely to slow. So slightly higher yields, a little bit less sort of demand or inflows into the asset class, combined with kind of less what I would call credit-friendly activity, means spreads modestly wider. And I think that's our base case, and I think there's a reasonable probability for that.